Hello and welcome to People and Power. I'm Summer El-Shahab. Now, free markets are meant to be fair, but are they really? The smallest investor in the stock market is meant to face the same odds as the richest. That's what makes free markets, well, free. And free markets are also meant to provide all participants with the same information about stocks, bonds and currencies. That way, all investors have an equal chance of making a profit. The market also allows investors to pool their resources into products called funds, so they can punch way above their weight. Pooled investments like mutual and hedge funds. Now, whereas mutual funds are weighted in favor of the small investor and are highly regulated, hedge funds are for riskier products and are weighted in favor of wealthy people who are seen as sophisticated enough to take risks that ordinary investors can't, and they're hardly regulated at all. So everybody comes out of the market a supposed winner. Max Keiser disagrees. He argues that hedge and mutual funds are manipulated to benefit brokers, bankers and the richest investors, to the detriment of those with less power and less money.
Free markets. We're told they'll bring prosperity and freedom to all. Let the markets decide and we'll all be rich. The question I have is, are the so-called free markets rigged? Check kiting, bear rating, front running, backdating, look back trading, pump and dumping, wash sales, match sales, blank check IPOs, parking stock, painting the tape, market timing, late trading, shearing, spring loading, bullet dodging, oh, and my favorite, naked short selling. These are just a few of the many, oh so many ways that brokers, bankers, and CEOs use to defraud other market participants. In 1602, right here in Amsterdam, the first stock market started trading. Already, by 1610, market manipulators and insiders were figuring out ingenious ways to take advantage of other market participants. Now, by the 1920s, brokers and bankers had become so good at fleecing investors out of their money that the sheer weight of all that fraud led to the Great Crash of 1929. In America, the Securities and Exchange Commission, or SEC, was introduced to restore faith and credibility to the markets. A raft of legislation was brought in to protect investors from the bankers and the brokers colluding, the event that triggered the crash. Never again would markets be rigged to within an inch of their life. But recently, an SEC insider, Gary Aguirre, has written a remarkable letter to the U.S. Senate. In it, he claims, after studying the effects of what he calls the modern equivalent of the trading scams that led up to the 1929 crash, a repeat. That's right. Gary Aguirre, SEC insider, believes that we are facing once again market conditions that are almost exactly the same as, you guessed it, 1929.
Dear Chairman Hagel and Ranking Member Dodd, I believe our capital markets face growing risk from likely unregulated hedge funds, just as our markets did in the 1920s from unregulated pools of money, then called syndicates, trusts, or pools. Those unregulated pools were instrumental in delivering the 1929 crash. There is growing evidence that today's pools, hedge funds, have advanced and refined the practice of manipulating and cheating other market participants.
They are basically means tested, where people have to have X amount of net worth before they're allowed to play the game. And after they're in the game, their investments are not subject to the rigors of the SEC, the New York Stock Exchange, all the reporting, all the regulatory agencies that keep watch on public companies.
I suggest that The good old times are now back again.
Yes, the hedge fund manager is the high-stakes croupier of choice for the super mega wealthy. They're trying to make as much money as possible at any cost. Some of these funds are bigger than countries. George Soros, for example, made a huge bet and broke the Bank of England.
The concern about hedge funds is that because they're so leveraged, in other words, for every $1 in capital invested by the shareholders in a hedge fund, they may borrow $10 or even $20 of capital from banks. If that hedge fund gets into trouble, that could put the banks potentially into trouble, and that's the concern.
So how do hedge funds make so much money so consistently? Well, it's all about risk management and leverage. For example, a hedge fund might borrow $1 million to make a bet they'll roll snake eyes, while simultaneously borrowing another $900,000, making a bet that they won't throw snake eyes. Well, if they do throw snake eyes, they make $100,000. That's $1 million minus the $900,000 cost of the hedge. If they don't throw snake eyes, well, the $900,000 will pay off at $1 million. So it's really a matter of heads they win big, tails they don't lose. With odds like this, hedge fund managers never lose.
Hedge fund trading now dominates the nation's capital markets. The $2 trillion under hedge fund management are on steroids. They recycle at high velocity through the markets. With that $2 trillion, hedge funds execute up to 50% of the daily trading on the $21 trillion New York Stock Exchange. This trading is the matrix for future financial crisis.
Hedge funds allow financial institutions to offload risk that they don't want to carry on their balance sheet to people who are willing, ready, and able to assume that risk. There are others who would argue that this is a shell game, and this is a means by which banks or broker-dealers or people who originate risk can sweep the risk under the carpet.
All of this shenanigans with hedge funds is not unknown. It's well documented. People understand that they're getting ripped off. Where are the regulatory authorities? Well, it appears as though the regulatory authorities in the fund community are in cahoots. There's a conflict of interest. The problem is that there's so much volume daily generated by the funds that they distort prices across the board. So the little guy gets hurt, caught in the crossfire of these huge funds shooting at each other using massive bets. It's almost a form of collective punishment for the little guy. So how about an example of this collective punishment? By the way, the rich people will tell you that they're sophisticated and therefore don't need to be regulated. I'm not sure I buy that argument. But nevertheless, they have, for example, a technique they use called naked short selling, which means that the hedge funds and the brokers get together and they counterfeit stock. They print up stock that doesn't exist, simultaneously making a bet that the value of the stock goes down. So as they counterfeit more shares and flood the market with counterfeited shares, thus driving the price of the share down, they're guaranteed to make a profit because the profit's based on the share price falling. It's called naked short selling. You would think the regulators would be against it, but they're dragging their feet. Why?
What I find amazing about the SEC and their admission that naked short selling occurs is when people question them as to who's conducting naked short sales, as in who are the participants in naked short selling, who are the brokers that are involved in naked short selling, who are the brokerage firms that are sending counterfeit IOUs for ownership of stock, and the SEC doesn't want to publicly disclose who the perpetrators are.
It's a real issue because, in theory, the big manipulations that we saw back in the 19th century were as a result of not having share certificates, and you were effectively doing naked short selling. And this process has somehow reemerged in recent years, and the authorities seem to have allowed it to happen. Now, I understand it's being addressed and reviewed by the SEC as well as other regulators, but as I understand also, the practice of naked short selling is still continuing.
After the break, Max Keiser continues his unique take on the workings of hedge funds.